Well, if you were expecting the Federal Reserve to reveal any clues in its April statement about when it will raise short-term interest rates, you were disappointed. Released on Wednesday, its statement was vague and reiterated points the central bank has long maintained about employment and inflation. So for investors, how do you digest this? Steve Blitz is the chief economist at ITG and joins me now on set. And Steve, the Fed was vague, but you say they gave a pretty straightforward assessment of where the economy stands.
Yeah, they really did. You know, they could have come out with a statement that was more of, well, you know, the first quarter was transitorily weak because of the winter and other factors, and that we expect a rebound later in the year, starting in the second quarter, because we've seen this before. But instead, what they did was they gave their bit that said, yes, the economy slowed and it was transitory, as that, you know, any central bank would say. They're not going to say anything worse than that. But they downgraded their assessment of the employment market by saying that underutilization is not improving. They said spending by households is going down. They didn't say it was going to reverse itself, and they kind of downplayed a little bit of the recent increases in personal income and saying that it's really, the real numbers are up because energy is down.
And they acknowledge a lot of the weak economic data we've been seeing in recent weeks,
right.
But yet they're still confident that inflation is going to move back towards their 2% target in the medium term. Do you buy that?
Well, yes, I do believe that they're still confident that it is. I think
But will it move back?
Well, I think over time, in fact, that sets up really for the problem they're going to begin to face, I think, come June, which is when they meet in June, I think they're going to see that the inflation numbers, the core inflation numbers, have transited through the down move from lower import prices and more so from lower energy prices. They're already beginning to show a little bit of a lift. And it'll be very difficult for them to say, I think, in June, that they're not seeing a trend that says we're getting back towards 2% over the medium term and that they could have reasonable confidence. The hard part of that, or the conundrum, so to speak, to use a lot of the language they like to use, is that while that might be going on, the economy really is going to be still stuck at a rather mediocre rate of growth. The unemployment rate probably is still in that 5.5% range and not really making tremendous progress towards much lower numbers. And on top of that, they're really going to be set in this situation where they are now, which is that they need the housing market to begin to pick up because they know nothing else is really going to lift the economy. And if we do get stronger housing, which we think we will see, in the second quarter, but is it going to be strong enough to offset everything else?
But what about this weak GDP report this morning? I mean, 0.2% growth, the expectation was 1%. Yes, there was cold weather, but can they really raise rates in 2015? I don't see how they can.
Well, I think to the extent that, you know, we've seen this before, right? So to the extent that you get what a number of FOMC members believe will occur, and that you get strong 3-4% kind of quarter-over-quarter growth rates in the second and third quarter, yeah, they will come in September and do that. But to get that kind of number, to get to that point, as opposed to last year, you need the housing market to begin to accelerate. And in truth, it will accelerate, but will it accelerate enough to offset everything else? Well, that's a big question.
And just real quick, for investors, what should they do? I mean, it seems like the best thing is to just ignore the Fed right now.
Well, ignore the Fed at your peril. But I think, you know, investors should always be medium to long term in terms of their investing, and, you know, day trading, leave that to inside pros to do that. That's not really something regular investors should really be engaged in. If you like the company, you think the profits are there, and you own it at a good price, just see yourself through this day-to-day volatility and just keep owning it.
All right, Steve Blitz, good advice. Thanks very much for coming in.
Thank you.
I'm Scott Gamm, and you're watching The Street.